During this month, we have witnessed China's largest transition of power for over 3 decades, as almost 75% of the committee members were replaced due to their age. The biggest question across the world, and particularly in South Africa, is what does all of this mean for trade and relations? To help us unpack this is Matthew Birch, lead strategist at Gibbs. Well, Matthew, thanks very much for your time. Does this have dire consequences for us, or does it mean better times ahead?
I think it depends how we as South Africa decide to play it. I think it's been a fascinating transition over the past couple of weeks, and when you compare it to the US transition of power, where the US spent $6 billion on elections and took 18 months, China seemed to do the transition within a week, and they have a lot more people. So I think for South Africa it really is the ball's in our court. It depends how we play and how competitive we can become to take advantage of the growth in China.
Matthew, when you look at China, I mean, obviously this is the growth engine for the world. It's critically important to the South African economy and our stock market, etc. What's the danger to Chinese growth slowing down? Is it higher inflation? Is it the debt at municipal levels? Is it unrest? What's the true danger for a sustained Chinese slowdown?
I don't think it's inflation first and foremost, because the structure of the Chinese government allows them to pull the levers of finance quite quickly.
Okay.
And we've seen them quell that very quickly in the past. I think it's going to be business as usual till about 2018 for the next 5 or so years with Xi Jinping at the helm. Post those 5 years of orientation, I think we're going to see strong political and economic reform. And I think that will be the biggest risk. It's not a burning platform in China at the moment, but corruption, political change is necessary. How it happens will be over a longer period of time. But certainly it's going to be a planned out route within China as the dynastic succession has taken place.
China's competitive advantage is its labor arbitrage. How long has that still got to run? What point is China's labor at par with most of the emerging market?
Well, it depends how you unpack it. Parts of the labour arbitrage have come to an end. So an engineer in London, United Kingdom, is the same price as an engineer in Shenzhen in China. However, labour is still very cheap. And I think people talk about Mexico and other areas around the world which look attractive from a manufacturing standpoint. But as China moves away from the east coast of development further into the west, there's still many semi-skilled and unskilled people which they can take advantage of. So I think the idea of competing with the China price isn't going to go away anytime soon.
Just looking at China as a whole and the impact that it has on the resource base in South Africa, are you concerned about a slowdown down the line?
I think what's been interesting is in China has gone through a little bit of a slowdown, certainly not a hard landing. And the interesting fact...
Still very much in the soft landing space.
Very much in the soft landing space. Our GDP results were pitted today in South Africa, and we're left in the dust compared to China. I think what's interesting is that the economy softened slightly, and we're going to see imports reducing slightly, and that means that there's going to be more access for domestic consumption, which will grow demand for resources from South Africa and Africa. The fact is, though, is that per ounce we are one of the most expensive places to mine at the moment in the world. And that's going to play against us because there's many...
So we're going to kill our own industry. It's got nothing to do with China.
There's a possibility of that. The reality is that we're no longer the gateway for business into Africa. There's many other African countries that are taking advantage of these trade relations, and I think we need to really boost that area in our economy.
Now, look, I must say, when you look at China and the spectacular growth they've had in the past, what is a sustainable level? Is it the soft landing level at 7%, or is 9% sustainable? Because all of this ultimately has got to be funded by some sort of money creation or credit creation or wealth creation, which will ultimately lead to domestic consumption in China.
Sure.
So what is sustainable?
Well, I don't think 10, 12% is sustainable
Yes.
over the next 10, 20 years, and I think the Chinese are very well aware of that. So they are focused more on domestic consumption, and if you look at the domestic consumption growth, it's actually increased quite dramatically over the past 5 years. I think what's interesting is that when Xi Jinping was elected into power was his conversations around corruption and how harsh he was on that corruption. Because as the economy opens up, as social media increases, there's going to be more and more accountability towards politicians and having a less corrupt party. And we all know by nature of a one-party state, and they say socialism with Chinese characteristics, that there is major corruption. I just need to make the point, though, that the corruption between China and other emerging markets is very different. It's delivery first, corruption second. And in very much other emerging markets, it's corruption first, delivery second.
How?
So that's better.
Well, it's a lesser
of two evils, yes.
All right, no, just getting context here.
What's the what does it do to China's competitiveness if it becomes a consumer rather than manufacturer and exporter? What price level do they buy from the world at now?
Well, I think China doesn't want to be the blue jeans manufacturer of the world for the rest of their time. They are certainly going to start climbing up that value ladder, that product value chain. I think their competitiveness will always be there. There is an extreme work ethic in China that many other countries cannot replicate. So we can look at it from an economic standpoint, but when you're there, and I was there recently, the work ethic is extremely high. So I think the competitiveness will always be there in one form or another. You match that work ethic with a high level of education, high levels of education, and you really have a power that can sustain those types of growth, or just below the types of growth they are for some time to come.
Often when we chat to the China experts, specifically on this show, many allude to the risk of municipal debt and that is one enormous risk to the overall Chinese economy. Is it a real threat?
I think it could potentially be a real threat. I think we've seen some results come out today of how state-owned enterprises, municipal companies, and private companies have done, and by and large, private companies are doing better. I think as Westerners and through Western eyes and Western media, we see China as a communist or certainly a corporatized type government. And that's not always the case. I think that they still have a lot of diversification to go. And what they're starting to do is not the model that we as South Africa were thinking of adopting, which is more state involvement. They're moving to less state involvement. And so the trend is towards more municipal involvement and more privatization.
An interesting case study in the South African space must be Standard Bank and the tie-up with ICBC. Are we going to see more of those kind of ties up?
I think we're going to see a lot more of those. I think we haven't even seen the amount of M&A, outbound M&A coming our way. I think we're going to see a lot more consolidation in the industry with Africa. We've already seen that with some of the banks. We've seen a lot of South African banks getting into Africa through Chinese banks. So the consolidation will start to occur more and more, especially as the contraction of physical and monetary policies occur in EU and America.
Just looking at another bank, the China Construction Bank is established here in Sandton. Are we going to see pure play Chinese companies without JVs?
I think CCB is maybe a once-off. I think the Chinese find it very difficult to operate in South Africa. We have deep industry expertise around banking and mining and infrastructure development. So they've obviously played in other African countries. And that may have played against us because we thought we were the gateway and we're not the gateway anymore. If we put Nigeria on our doorstep, I'm sure this country would look very different.
Matthew, when you take a longer term view, I mean, as China gets richer, as their GDP per population grows, they're going to move up let's call it the wealth chain, which implies significantly more specific protein, but significantly more food consumption. What about the production of food being, let's call it a savior of Africa? Do you think that is a potential?
Well, I think that's a very interesting point. So when you travel in China, they've got something called the pork index, which we don't have here, and that has a direct relation in terms of inflation. I think the deals that you've seen in Africa are going to start moving away from infrastructure and more to agriculture. The reality is that China cannot produce all that amount of food. The topography doesn't lend itself to producing mass amounts of food. And so you're going to see what's happening now is that many subsistence farms will be brought together, bandied together, and mechanized to develop production for both South African or African countries as well as China.
Quick one from you, Hlelo.
Right, so in that scenario of China moving up the wealth chain, please help us understand what happens to the relationship between China's foreign currency reserves and the US dollar. Since they will not be exported anymore as much as they used to, what happens to their money? Do they bring it back? What happens to their currency, to the US dollar?
Well, I don't think we should think of as what Mitt Romney said, that China are a currency manipulator. I think we're going to see the renminbi, the yuan, appreciate drastically over the next 10 years and come into normalized values. But I think what it really means is that they will have a lot more money to spend in terms of development internally and domestic consumption. I think we'll see a weakening of the US dollar, whether we like it or not. The physical cliff is coming. They've rearranged the debt chairs. They're kicking the can down the road, but sooner or later, it'll have a great impact.
Quick one from me. Do you speak Chinese?
Yes.